Greetings everyone, this is Kushal here from Purple Trades. Today we are starting a whole new concept, that is technical analysis. Before we start this series, I hope you have watched our series on basics of stock market and understood what stocks are. Moving a step ahead, we are now going to talk about technical analysis and how it helps you take trades. Starting today, we will introduce you to technical analysis and discuss how it actually came into existence and what is Dow theory. So without wasting much time, let's get started. What is technical analysis? Now, technical analysis is a study to forecast future trend of the stocks or futures or options based upon only price actions and volumes. Technicals only works on the price of the stocks and the volumes, that is how many people have bought and sold the shares at any point of the time. Based upon that, we build a lot of indicators. However, technicals does not involve any type of balance sheets or cash flow statement or income statement or any type of fundamental aspect of a company. Technicals in itself is a separate study where we see only price and volume, and based upon that we build a lot of forecasting tools. Since there is no fundamentals involved, we can apply technical analysis on all the trading forms. We can apply it to trade for intraday, for swing trading, for positional, for long-term investing, for patterns like STBT, BTST. BTST means buy today, sell tomorrow. STBT means sell today, buy tomorrow. In all these simple types of trading, you can use technical analysis. Since technical analysis involves only price and volume, there is no need of balance sheet or fundamentals. Thus, we can apply technical analysis on those tools which do not have their balance sheet. Tools like commodities like gold, silver, crude oil, we can use it on futures, options. We can also use it on currencies and even cryptocurrencies like Bitcoin. The main analysis involves price graph and plotting tools developed on price and volumes to forecast a trend. Now in our coming lessons, we are going to talk about a lot of tools that we will develop. We will understand how the tools were developed and how they are helping you generate entry and exit signals. Now, technical analysis was first discovered by Charles Dow. He is also called as father of technical analysis. Charles Dow was the owner of Dow Jones Company. Charles Dow was also the first person to create index. Charles Dow wrote a lot of theories called as Dow Theory, and Charles Dow was the first person to actually create an index. Now we have spoke about index in our previous classes. We spoke about indices like Nifty, Sensex and Bank Nifty. Charles Dow was the first person to actually create an index. Not only one, he created two indices, namely Industrial Index and Transportational Index. And these indices were created more than 100 years ago. Back in those times, we had industrial age, and the economy of the country mostly revolved around industries. How many industries a country has and how much goods are getting supplied, based upon that the development of the country was decided. So he smartly focused upon two things, that is industry, and he created industrial index which had stocks which are involved in industrial productions. And he created a transportational index which is involved in transporting goods from industry to urban area for consumption. Dow said divergence in these two indices are the early sign of overall trend reversal. Now it is very obvious that if the demand for goods is more, industries would perform well, and if the industries are producing more goods, they will be transported more often. That means if industries are growing up, the transportation of that particular economy will also go up. That means industrial index and transportational index in a growing economy will move positive together. Similarly, during recessions, goods or consumption will reduce, because of which industries will perform poor, and because of which goods will be produced less and they will be supplied less. That means transportational index will also get hampered. That means during recession, industrial index and transportational index will both go down. However, there are cases when industrial index is going up and transportation index is going down. That means more goods are producing but they are supplied less. Now these are early reversal warning signals. That is, there is a divergence, one is going up, the other is going down. Similarly, sometimes industrial indices used to go down, or industrial index used to go down, and transportation index used to go up. Now this divergence is also a signal of trend reversal or warning that something is going to change in the economy. Now Dow used to forecast trend using such divergence. Dow theory were formed 100 years ago, but the fact that the few theories are valid even till today is extremely fascinating. Dow wrote a lot of theories in his industrial age. Today in the modern era, we are into technological world. Few of his theory are not valid, but however, few basic theories are valid even today after 100 years, and which is an amazing and extremely fascinating fact. Dow created his own theory, but before publishing his theory, he passed away, but his disciples or his students published his theory in his book. I have mentioned the link of few books of his disciples. You can read them in your free time. Let's try to understand what were Dow theory. We'll understand few of the Dow theory which are valid even today. The first theory that we're going to talk about is price discounts everything. Now this is very important theory that Dow proposed, which completely changed the aspect of how people see the stock. Back in those times when there was no information and there was poor literacy rate, not everyone was good at reading fundamentals of a company. Not everyone knew how to evaluate balance sheet of a company. Not everyone knew how to check whether a company is undervalued or overvalued. Dow simplified this by telling them that they need to only focus on the price of the stock, and he said that price discounts everything. That means current market price of the stock has all the information stored in it. It means if you are good in understanding the current market price of the stock, you will come to know what is happening in the market. For example, if a price of a stock from 100 is going up to say 150, that means the stock is doing very good, or something good has happened with the company, or it might have got very good profits. Similarly, if there's another stock of 200 rupees which is falling down to 100 rupees, that means something very bad has happened with the company, or fundamentals are not good, or company is not making enough profits. So any news or any factor that can influence a company, be it a positive news or a bad news or any economic factor, is directly reflected in the stock price. That is why we say price discounts everything. So that means you can understand the price action and you can forecast in which direction the stock is going to go without even touching the balance sheet of a company. Now this is the best part about Dow theory. Dow also proposed another theory. He said that a trend can be categorized into three sub-trends. There will be three types of trend. There will be a single trend that will be sub-categorized into three sub-trends. What are they? First is the primary trend, or the longest basic trend, which usually lasts for a year. Now in this single trend, be it an uptrend or downtrend, there are a lot of sub-trends. First is the secondary trend, the trend within the primary trend, which is in both upside direction and the downside direction. Primary trend lasts for years, whereas secondary trade lasts for few weeks or months. And the third is minor trend. Now minor trend is within secondary trend, and it is also in both upside as well as downside direction, and it also usually lasts for few days. Let us try to understand by taking an example. Now here I have a stock which was in a clear uptrend. From the beginning point, from this beginning point till the end point, it has gone up. But if you can see between, there are a lot of trends. For example, while going up, it came down. So this down trend is your secondary trend, but in the downtrend there are again small minor trends. Similarly, in the same uptrend, the market was falling down. Now when the market was falling down, in the secondary trend, there were again minor trends going up and down. So any trend has a secondary trend as well as minor trend. Now in this case, we have a primary trend, that is uptrend. There are a secondary trend which are downtrend as well as uptrend, and then there are minor trends which are also uptrend as well as downtrend. Taking another example, Here in the downtrend, you will see that when the market was going down, in between there was an uptrend. Now in this secondary trend, there are again minor trends which are going partially down and up. Similarly, in this trend we have again a secondary trend here. In this secondary trend we again have minor trends. So primary trend is a downtrend in which there are secondary trends which also involves minor trend. Now this is again a theory proposed by Dow which is valid even today. Another theory which Dow proposed is history repeats itself. That means whatever has happened in the past will happen again in the future. Now you might be thinking, how is it even valid? For example, if last World Cup Australia has won, will it win again? Will the history repeat itself? Not necessary. Then why did Dow say this? Now when Dow said history repeats itself, there were few terms and conditions associated with it. Dow says history repeats itself provided the conditions in the past and the future or the present would match. For example, if I take you to a movie and it's a scary movie and there are around 200 people sitting in the movie, and if suddenly a horror scene comes in the movie, you and all the other members in the theater would get scared. Now if I remove all the 200 people and a new set of 200 people would sit and watch the same movie, their reaction would again be the same. That means history is repeating itself. Why it is repeating itself? Because the condition in the first case and in the second case were same. Humans tend to react similarly when they are faced to certain situations, and hence history will repeat itself. If you get scared by seeing an animal, you tend to run. If anyone else would get scared by seeing an animal, he or she will also run. So human emotions are constant. We tend to react similarly, and because of which history tends to repeat itself. This point looks very small but is the foundation of major technical indicators and tools that we use today, a few of which we will discuss in immediate next lesson. The point history repeat itself is a very small point, but the most important point in technical analysis. So in the next lesson we are going to talk about a lot of technical theories. We are going to talk about what is support, what is resistance, what are the types of support and resistance, and you would be amazed to know that support, resistance, pivot points, all these factors or all these advanced technicals that we use today have been derived from the single line that history repeats itself. We are also going to talk about risk reward using support and resistance and pivot points. All of this we'll talk about in our next lesson. Thank you so much for watching this video. Please do spread the knowledge because it is free, and if you like our video, do like, subscribe and share it with your friends. Thank you so much, and I'll see you in the next video.